Good morning. Can you talk about the strategy of the fund you manage, the Pictet US High Yield?
Yes, US Pictet High Yield is a domestic, it's a US high yield fund. We have a focused on domestic credits. It's benchmarked to the Barclays High Yield 2% index. And our goal is to outperform the index on a risk-adjusted basis over the full cycle. We have an approach that is a full cycle approach where we take more risk when the markets are compensating us to take more risk. We take less risk at times like today when we're looking at late cycle behavior. We're looking at tighter spreads and deteriorating underwriting standards. So our goal is, as always, is to offer an attractive risk-adjusted return over the full cycle. We do this in a number of ways. The first way is we focus on downside protection. We focus on asset-heavy industries. And the second way is we take a full cycle approach, meaning we move up in credit quality, we move within capital structures to get more defensive at later times in the cycle. And at earlier times in the cycle when spreads are wide and we're being compensated, we'll get more aggressive with the portfolio positioning. So the portfolio really is a dynamic approach to U.S. high yield that we think offers a way to gain exposure and attractive risk-adjusted return over the full cycle.
Which sectors in this moment are more attractive in your view?
The philosophy that we pursue leads us to favor certain sectors over others from a structural basis. So the way we approach U.S. high yield is we tend to focus on companies that have higher tangible asset value. When we look at the market today, we tend to favor sectors such as utilities and even some portions of the energy market. And the reason that is because when we look over the course of the last 20 years, what we've observed is that the default rate in the utility sector and the energy sector is significantly lower than that of asset-light sectors such as retail and technology. And the other important point is that utility companies and energy companies and other asset-heavy industries, even though there is a default experience, they tend to recover significantly higher. When you compare defaults in technology and retail, what you find is that the losses experienced upon default are significantly higher. And we think over the full cycle, the way to outperform is to limit those losses. And so the loss experience is much more important than the default experiences, as we tend to focus on the loss given default as opposed to the default experience itself.
Which kind of investors may be more interested in this fund?
We think the appropriate investor is one that understands that they are invested in a leveraged finance product, which means that there will be volatility associated with the product. The goal of our fund, however, is to offer a more attractive risk-adjusted return. What does that mean? That means that later parts of the credit cycle, our fund might outperform. I think the goal of our fund is to offer a prudent risk to investors. I think at late parts of the cycle, our opinion is that there are certain managers that might pursue a different philosophy. They may continue to move out the credit spectrum to pick up incremental yield at exactly the wrong time. And our thoughts around that are that when a manager reaches out the credit spectrum at late parts of the credit cycle, what they're doing is pulling forward tomorrow's loss, and what they're doing is experiencing more income today at the expense of tomorrow's loss. And our goal is to limit some of that loss and reduce some of that volatility over the full cycle and enable us to get more aggressive in dynamically positioning ourselves once the volatility increases. So we tend to underperform at late parts of the credit cycle, and the investor that will allocate to our fund is one who wants to experience a higher risk-adjusted return over the full cycle, might outperform late cycle, but might underperform in the late cycle, but would outperform in a significant way during inflection points, and would certainly outperform on a risk-adjusted basis over the full cycle.
Thank you.